Hello everyone, this is the second lesson for property, plant and equipment, and we are going to review two situations: change in depreciation estimates including improvements in the property, and disposals and gain and loss on disposals. Let me know if we are having any sound issues or quality issues. I will check myself. So my picture on my phone is reasonably good, and the sound, let me see. I'm not sure I'm hearing the sound. Everything seems to work. So what's going on there? Okay, so everything is working. Let me know if we are having any sounds or quality issues, and let's begin with our lectures. Okay, so in the previous lecture we figured out that we might have a situation when we determined the useful life on the asset using our best judgment, and we determine the salvage value, and as time goes on something might happen, and we might have decided to do some improvement to the asset, and that improvement changes our estimate for the useful life of the asset. So what happens in such situation? Let's see. So first of all, we do not go back in time and try to revise our estimates. We only look on that prospectively. And prospectively, that means that when we figure out that the useful life of our assets changed, we revise our depreciation from that point of time into the future. So let's consider an example here. Let me add some size here. Cost of assets 100k, value 0, initial useful life estimate 5 years. After second year we spent 30,000 on improvement, and that extends useful life by 3 years. And we have a question: what is the annual depreciation expense for each of the first 2 years? What is book value at the end of the second year? How do we account for the improvement? What is annual depreciation expense for years 3 and beyond? So to answer these questions, let's revise the principle. So we say that we apply the change prospectively. So for the first 2 years we will use our initial estimates of 5 years and 100k depreciable basis. Depreciable basis is our cost minus salvage value. Okay. So annual depreciation expense for each of the first 2 years, 100k minus 0 salvage value divided by 5, 20,000. At the end of the first year, at the end of the second year, our book value will be 60,000. How do we account for the improvement? And improvement, in that situation, we capitalize an improvement because it extended the useful life of our assets. And you might wonder, do we always, if we do something to the assets, like repairs or improvements, do we always capitalize that, or there might be situations when we have to expand that? And to answer that questions, we will need to take a look into accounting standard. But let's finish with our example now. For that example, the answer is to capitalize the costs. So book value increases to 90,000. So now at the end of the second year, our book value is 90,000. And we had useful life of 5 years. And at the end of second year, we have 3 years of old useful life, and we extended it to 3 more years. So basically, at the end of the second year, we have 5 years. Oh, sorry, 6 years. Yeah, years left, 6 years. And depreciation going forward will be 15,000. Okay, so we could fill up. I mean, you can do that as a part of your exercises to fill up these tables. We won't do that now. Hopefully that example is clear enough. Let's do a quick look into accounting guidance. I've already shared it, but I will do it one more time, just in case. That's financial statements, that's property, plant and equipment. So always, as an accountant, you would like to always consult the guidance, unless some operation becomes so routine for you that you don't need to do that anymore. Okay. So that's the accounting guidance, and let's see what we have about that on maintenance. Let's see what we have about maintenance. Maintenance can be a significant activity for reporting entities with capital project. Maintenance programs may involve the use of internal resources or third-party providers. Okay, so that's a bit complicated, not directly related to our case. Let's see. Accounting for capital. Oh, in service stage. So when we have our assets in service, what do? We can have repairs and maintenance expenses. We can have replacements of existing components. We can purchase additional components. And the costs incurred to acquire additional components of PP&E or replace existing components of PP&E should be capitalized. The costs of normal, recurring, or periodic repairs and maintenance activities and all other costs related to PP&E incurred during this stage should be expensed. So you see, if we have repair and maintenance, we mostly expense it. If we make additions to PP&E, or if we replace existing components of PP&E, we usually capitalize that. In other words, costs incurred during the in-service stage that extend the existing service potential of the long-lived assets or replace significant components of the long-lived assets should be capitalized. Let me highlight this. Extend the existing service potential of the long-lived asset. Replace significant components of the long-lived assets. And the third, or it's probably included in that part. I would say that part includes first, if we extend useful life, of our asset, and second, if we extend the production capacity of our asset. So in these situations, we will have to capitalize whatever we did to property, plant, and equipment when it's already in service stage. So that's important. That's important for it to be in service. Okay. Lecture. Let's see what. Lecture 12. Cash flow, gain and loss. Okay. So here they allocated the acquisition, depreciation. So basically that is credit, accumulated depreciation, debit, retained earnings. This is an improvement. We paid with cash. Let me know if you do you want to make double entries for that, or it is more or less clear. Let me know about that. Changes, okay, and depreciation going forward. Let's move to disposals. So disposal is basically the sale or abandonment or scrapping of your property, plant, and equipment and fixed assets. And when you do a disposal, you usually have some proceeds, or you may have costs as well, costs to dispose of an assets. And you also have a net book value of the asset. And depending on whatever is higher, your proceeds from disposal, what you got when you disposed, you might get a gain or loss. Okay, let me tell this. We will do double entry for depreciation adjustment on practice. We will do that on practice because as you see, that involves many accounting periods. Let me just make a brief overview here. We will dive into more details. So let's see. Our debit equipment was 100. Okay, and we paid with cash for that. And so depreciation for year 1, it was 5 years straightforward. So that is and we have depreciation expense equipment debit, and credit would be accumulated depreciation. And we can move so on. So we will have depreciation year 2. And it will be basically the same for year 2. Okay. Depreciate year 2. End of year 2. Improvement for 30. We capitalize it. We capitalize it to the same account. It's here. 30. And we credit cash. We paid for it with cash. Credit cash. year 3 revised. Okay, so revised depreciation will be same entry. Debits and credits will be the same. The amount will be different. So we need to figure out depreciation basis. NBV so our NBV will be 100 minus 20 minus 20, and our improvement will be 30. So we depreciate this. Let's be consistent. Minus this. No, let's add accumulated depreciation. That's the more correct way to calculate it. The numbers are the same. And then we add equipment. Okay, so let's see what we got here. 90. Let's just add. So 90 is our new net book value, and let's call it here 5 minus 2 plus 3 years remained at this point. So that's what useful life remained at this point is. It's a 6 years. So we divide it by 6, and going forward until we reach 0 for the next 6 years, we will depreciate it for $15 per year. Now let's see if we have any examples for our disposals. Okay. Let's now go back to disposals. So when we do a disposal, we remove assets historical costs and accumulated depreciation from the balance sheet and record gain loss. So they give us an example here, but let's use our example, which we have just done. This one, let's say we disposed of the equipment above at the end of year 3 for let's say 100. We do have some supply shortages and inflation, so we disposed of the equipment for 100. And let's do a bit more analysis in a detailed way. So first, remove assets historical costs and accumulated depreciation from the balance sheet. Okay, let's do it step by step. So we credit an equipment account, and the amount we credit the equipment account is whatever we have for the cost of that assets which will be 100 plus 30. So if you see, and that's actually should be negative. So if you see, all of that should net off to 0. Okay. So that nets off to 0. And that means that we removed historical costs. Now we should do that with accumulated depreciation. And we look what we have for that assets in accumulated depreciation. And we debit that account. So we have 15 from that year. We have 20 from that year. We have 20 for that year. And I should just the only thing which is not right here is that I should just add these numbers. Okay, 55. Let's see, 20, 20, 15, 55. Okay, so we removed the assets, but our entry doesn't balance yet. So the entry is unbalanced. And we need, what do we need to add into equation? Let's say 100 cash. So we debit cash for 100. Let's call it reflect proceeds. And our entry still doesn't balance. Let's see. We disposed of the assets and net book value of that asset was $75. We got $100 cash for it. So we kind of made some money of that assets. So I would call it, so that should be credit. Yeah, it should be credit to balance all of that. And the credit should go to gain loss on disposal of assets. And that should be a gain. Just I am adding these comments here, but that is still the same entry. So this is one entry. This is all one entry. So that's how we figure out gain loss on the sale of assets. We remove the cost of the assets sold from equipment list. We remove accumulated depreciation for that piece of equipment. We record the proceeds, and our gain loss will be the balancing amount for that number. So our total entry nets off to 0. Okay, let me check. Okay, I have strange. Oh, now it should be better. I have a settings on my microphone about different patterns. So hopefully now it works good. Okay, let's go back to the lecture. At the end of the 7th year, when book value is 15,000, sell assets from last example for scrap value of 2,000. Okay, so they also referred to this example, but they wanted us to depreciate it for 7 years. And let's see, is it all the same? Yeah. So basically we got 2,000 cash, we removed the assets from the book. We have a different depreciation, accumulated depreciation here, because in our case we only used 3 years of depreciation. In their case they use 7 years of depreciation. So basically 60,000 depreciation difference, not 60,000, sorry, 45 different. And they have different proceeds, and as a result they have a loss on depreciation. Here is a reflection of all of that in your T accounts if you run ones. So you got PP&D here, you credit, you remove the PP&D here. You have accumulated depreciation account, it's a credit account, you have your balance on a credit, you remove it in a debit, then you debit cash, and you balance everything with a loss, gain or loss on an asset sale. Okay, it looks weird, but that's a double entry for their case. Statement of cash flow. As you remember, a week ago we have lectures on the cash flow statements, and this week we have practice on cash flow statements. And we reviewed what happened with PP&D transactions on a cash flow statement. Basically, when you have cash flow from or used by in investing activities, you reflect PP&D purchased on that cash flow, disposition of PP&D, so cash received from disposition of PP&D also go to investing activities. Let's see, where is our practice file? So here it is, investing, building acquisition, cash outflow here, equipment acquisition, cash outflow here, proceeds from sale of equipment, 14,000 here. What's regarding our last transaction? When we got proceeds, we will reflect these proceeds in investing cash inflows here in that line. What about the gain? What about that gain on the disposal of assets? If we do cash flow with indirect method, the gains on disposals on property, plant and equipment will be adjusted here. These gains are included in our net income, and when we reconcile net income to operating cash flow, we need to adjust for those gains to present the amount in the investing cash flow properly. What else do we have here? What if PP&D is purchased using borrowed funds? We have two scenarios here. One, if we got a borrowings from third party and we have a similar transaction in our transaction list in the beginning of our lectures, we bought a building on mortgage. Okay, here it is. Building cost 200,000. We paid 50,000 cash, and we borrowed 150 to finance that. And the borrowing came from a third-party lender. In that case, we report gross amounts. We report total cost of the building and mortgage non-current. If we go to our cash flow, here it is, building acquisition, 200,000 cash outflow, proceeds from mortgage on building, 150,000. So, and net 50,000, that's our cash outflow. And the mortgage is in financing activities. And the second type of the situation, when you enter into the financial lease or your equipment is financed by the owner. Oops, sorry. I have a little accident here. So if it is financed by the seller, you will have to reflect only part related to the cash you paid. So let's see. I remember I added the example. So the same is applicable to financial lease or to the seller financing. So we bought equipment of 500. We paid cash 100. We get a note from the seller for 400. And in that case, we only send 100 to equipment acquisition. And we will have a seller finance equipment acquisition. This is will be a non-cash item. So let's see, where did I reflect it? Non-cash investing in financing activity, 400. So that's where it's under the cash flow. It's not it is not considered a cash flow. If it's from seller or a financial lease, it's not a cash flow. So it goes here, and for the investing activities, you only get 100. So here, 100. In the same situation, when the same transaction is financed by the third party, you will reflect 500 here as an outflow and 400 here as a financing cash inflow. Okay, what do we have in our lecture? Under the indirect method, firms start with reported net income and remove non-cash effects. What non-cash effects of PPE bookkeeping are embedded in net income? That's a good question, and we already answered it in our cash flows. For more details, you can review the lectures from previous week, cash flow, module 5. But to give you a quick overview, so when we do indirect method of cash flow, we adjust for depreciation because it's non-cash, and we also adjust for loss and gain on property, plant, and equipment because it's non-cash. And depreciation is totally non-cash, but that amount, it is connected, it is related to your proceeds from sale of equipment. So your sales, when you sell an equipment, you need to reflect proceeds in your investing activities. Okay. Okay, подходи. Только очень тихим. Okay, we have one more student here. Как тебя зовут?
Ивана.
По-английски?
Ивана Сергеевич Яшенко.
Ivan Theodor.
Ivan Theodor Яшенко.
Okay, that's my son. He will join us for some time. Okay, so what about so we figure out non-cash effects from PP&E bookkeeping. And the last part is practice. So what do we see here? We see change in equipment balances and intangible assets. We have depreciation and amortization. We have additions and we have disposals. And the exercise they offering us to do here is to... Oh, we also have capitalized expense. So they basically say that if we calculate the change in accumulated depreciation, let's see if they have an answers here. Okay, PP&E accumulated depreciation. So what they are trying to say us here that from that information, we can figure out.
Папа, я бойкий. Бойкий.
Ну это маме надо сказать. Она приготовит. У меня нет бургера. Okay, so what they are trying to say here is that having some balance sheet and income statement and cash flow information, we can figure out the rest. For example, if we want to calculate the amount of net book value of disposals, and we did such exercise for cash flow statement. Let's see here. Basically, what they are describing there is what we did with our roll forwards on PP&E. For example, cost. So for net book value roll forward or for accumulated depreciation, when we have beginning, so that data is available on your balance sheet or trial balance. Depreciation expense is available. Closing balance for accumulated depreciation is available. Let me remove these headers because they are no longer relevant here. And we can figure out that if something doesn't balance, it's most likely due to disposals of fixed assets. So we can figure out that item. Then we can figure out the proceeds from disposal. We actually should know proceeds from disposal. We can figure out the cash paid for PP&E as a balancing number based on our net book value. So that is a good exercise, and I will put it into the homework for today. Inferring PP&E events. And the remaining part of this lecture is about taxes and timing. So timing in this case means that in taxes there can be situations like bonus depreciation when you can take 100% of your PP&E purchase price and write it off in the first period. And in accounting, you will have to recognize the depreciation over 10 years on a straight line basis, for example. So in tax, you can have accelerated depreciation. And all of these differences, they impact deferred taxes. At this point, I can probably tell you that you need to be aware that there is such things as deferred taxes, and these taxes are related to different timing of the recognition of revenues and expenses in taxation and in revenues. That's probably all I can tell you. We will not look at these schedules today. That is all for this part of the lecture. Next part of the lecture will be about accounting guidance. We will do some overview of accounting guidance. It will not be a full overview of accounting guides. Only.
Папа, тут на которую я начинаю.
Ваня. Okay, so we have link, and here is a link to PwC accounting guidance. So thanks everyone for coming. Let's see what the plan was. So the plan was to start it at 11:30. Now is 11:34. Let's say we have a 10-minute break, and we will meet at 10:45. Okay, thanks everyone for coming.
Папа, тут стилизован. Тут стилизован.
Совершенно верно. Ты уже голодненький?
Да. Я хочу бургер.
Угу.
Папа. тебя две карточки.
Две карточки.
Да. Вон. У тебя вон две карточки. У тебя вон две карточки. Вон.
Угу.
И мне надо много карточек.
А зачем?
Они будут мне напоминать, в каком магазине я бил.
Окей. Сейчас мы, Ванечка, разошлем всем письма.
Папа, и мне эти карточки нужны без липучек.
Без липучек?
Без.
А как ты хочешь этого достичь?
Я потом такой такие липучки выкидываю в мусорник.
Мусорник?
Да, в мусорник.
Понятно.
Папа, выкинь эти липучки в мусорник. Я их вот здесь положу и не забудь их выкинуть потом.
Может, ты сам сейчас сходишь, выкинешь их в
Нет.
мусорник? Почему?
Потому что
Так, кто-то к нам пришел. Пошли проверим.
пошли.
Ты там что, закрыл дверь? Бабушку замкнул? Побежали. Идем, идем.
Папа, пойди в свой кабинет. Свой кабинет. Папа, пойди в свой кабинет.
Что, мам?
Папа, посмотри.
Давай, сыночек, у меня сейчас новая лекция, и ты хочешь тут со мной быть?
Да.
Ну хорошо, но надо тогда будет тихонечко сидеть. Так, давай, у нас тут надо закончить трансляцию, я ее почему-то не закончил.